Hey guys, welcome back to the Capital Mindset Show. Today we're going to be reviewing another stock request, and this one I think the timing is necessary, so necessary to bring it out now, and that is AMCX, not to be confused with AMC Theaters, okay? So we had a little bit of a discussion about this, very brief actually, on the Discord community, that if you want to actually be a part of that, it's completely free. You can click on the link down below, and then you can sign up. It will prompt you for about 3 questions, and that's to protect everyone in the Discord community from spam, okay? So you just have to answer 3 questions, and that's it. And they're not supposed to be like very serious questions. So taking a look at the company here today, the inspiration, I guess, came from a comment made by Paul from Everything Money regarding AMC being acquired by Netflix. So for those of you who don't know, I do own Netflix. I own Warner Brothers Discovery. And currently, as of recording this video, they stand at about 3-ish% for Netflix and 2-ish% for Warner Brothers Discovery, and that's after I have already sold my oil, well, not all of them, but I've sold a lot of the shares of my oil stocks and my mineral stocks for some profits, so profit taking. So even after that sell, that's their current percentage. Okay, so taking a look at AMC, we're going to be looking at it from the perspective of an acquisition, and it's just going to be speculative in that nature, but also from the perspective that what if the acquisition doesn't happen? Well, is this a good value play? So let's take a look right here at the price over the maximum time period allotted by Google. It is up only 5%, so it's been a terrible performer. Up more recently, though, it is actually down 29%. And the original video, or if you go on YouTube and you type in AMCX Stock, you'll actually see, I think, the #1 video. And I like to do that sometimes as a preliminary search as to what the noise is out there. But it was a video by the channel Everything Money. It was around this price because that's when it was posted. So it's potentially a chance to look at it even cheaper than when they were looking at it back then. So let's take a look at it together here today. I will mention some preconceived notions I have, and at the end of the video, we'll focus on the risks because I think the risks are very important. And the risks actually will be very similar to that of Netflix, which I made a video yesterday about Netflix. Go check that one out if you guys are interested in that stock. But taking a look at AMC and focusing on AMC, my preconceived notions are they're going to have a lot of debt. I haven't really seen it yet, but they might have a lot of debt. Them being small, they are a small fish in a large pond, which comes with some weaknesses. The weakness of scale, the weakness that they're potentially concentrated on just a couple shows, maybe a couple movies. So that's a risk there. The risk that they might not have enough money to diversify enough into many different shows, right? And that brings the risk of, well, you have to have a hit nearly every time. It's got to be more. You got to execute even better than the bigger boys. The bigger boys can afford to have some flops. You don't really get that same level of leniency. So it makes it a little more difficult. However, because they're so small, if they have some of those hits, it does make a bigger impact on their bottom line. So that's the other side of the same coin. So I want to be fair to both sides. All right, so taking a look at their website, you can see that they have AMC Plus. You can see the plus up there at the top. Well, actually, you guys probably can't see it, so let me actually come down here and bring you down there. So you can see it there. All right, let me bring us back here because you'll see why, because it's to optimize for when we look at financial statements. But AMC Plus, they have a subscription service. Some of this content, like Doctor Who, they don't actually produce it. They actually have the license for it. We will see that in the financial statements because they have to showcase stuff like that. Of course, The Walking Dead is, their big hit TV series. We have various branch-offs of The Walking Dead, such as Fear the Walking Dead. I think there was one down here. Let me see. Where is it? The Tales of the Walking Dead. So they're really milking The Walking Dead. And again, that's what my preconceived notion was, is that they probably are very concentrated in a couple shows, a couple hits. They have Better Call Saul. That's my brother-in-law's favorite show. But yeah, very interesting in terms of that. So let's actually take a look at the financial statements, and we're taking a look at the balance sheet first, then we're going to go to the statement of cash flows. I'm going to highlight the debt right there. You see the debt actually is larger. Yeah, it is larger. So if you guys see that line item there, debt is about 2.8, 2.7. So it is going up relative to the size. Let's remind ourselves of the size, 1.56. So that's pretty incredible in terms of, relative size. So they have more debt than actually the size of the market cap. Not the best thing, but and that's just a surface level argument, by the way. It's not entirely like end of the world. One thing I want to show is, right there, programming rights. That's what we were talking about. So that has a value because we recognize that as an asset because you have the right to use. So it's like a right of use asset, kind of like a lease liability has a right of use asset as well, like a counter asset. Or it's not technically a contra asset. I'm using the word wrong, but you get the point. So when you have the liability, well, that liability actually comes with a right, and that right is an asset, and those actually balance out. But taking a look at the programming rights, they are actually increasing, so they're probably making some acquisitions there. And if we look at the cash flow statement, the statement of cash flows, is this a statement of cash flows? Yes, it is. Oh, we got lucky there. So obligation program rights, so they look at that. So negative, large negative numbers there. Large negative number means bad, okay? No, but to be more serious, this is one thing that I've been covering in all of the streaming stocks that I've ever covered on this channel, whether it be Discovery before the merger, which Warner Bros. Discovery video will come. Just you wait on that one. I'm going to be very excited for that one. It's a holding of mine, so I better be excited. Netflix and Disney, all these companies, when I covered them, I kind of told you guys this already. The operating cash flows, it's very difficult to use those often as a barometer for how good the company is doing. In fact, with these instances, it might actually be good. A quick and dirty way is actually to use what in theory should be doing that, which is GAAP net income, right? GAAP net income is intended, or in theory is intended, supposed to be designed for investors to actually understand what it is that's going on in a company, right? And it does a fairly good job at it. Oftentimes on this channel, we'll use cash flows instead. I saw that, for example, the other channel that I mentioned, Everything Money, they use still cash flows, and I think that's a little bit of a mistake. Other creators have pointed out, correctly, that for these instances, it might actually be better to use GAAP net income because of this line item, this particular line item, because this is like CapEx. So CapEx is supposed to be, if you think of CapEx, it's like the investment you make into machinery, equipment to grow your business and maintain your business, capital expenditures. We have both maintenance CapEx and growth CapEx. Well, instead of CapEx for a streaming service, we have rights, programs, obligations, spending on content, basically. Just think spending on content. So that spend on content has both a maintenance aspect to it and a growth aspect to it, because you want to spend more to get even more content to perhaps get even more subscribers. And this goes with actually non-subscriber based, maybe even like, Hollywood-esque movies, and we talked about this with Disney, one advantage that they have. And if you haven't seen that video, I'll repeat that information here. One advantage is that when you spend that money on that Hollywood blockbuster, you can then actually go to the movie theater and generate a return and perhaps cover the cost of that movie before shipping it over to your streaming service where it can be rewatched. And you can make a profit on it at the movie theaters as well, which is an added benefit. Something that, as I pointed out in the Disney video, Netflix does not have at the present moment. They don't have a way to monetize the creation of it where it can cover the costs. Instead, the business model at present moment relies solely on the release inside the Netflix ecosystem. So AMCX does not follow that. They actually do produce movie content, and just not as frequently as Disney. Disney, you can very much see many movies a year. Same with Warner Brothers Discovery. So and also, by the way, Warner Brothers Discovery is actually at a cheaper cost basis than I think my average cost basis. So it is something that I will think about accumulating, because I like to wait and see what's kind of going on with the overall business. I might buy before that happens because the market might be thinking the same thing. And oftentimes in other companies I've owned in the past, like with Raytheon Technologies, Otis, and Carrier, those three would spun off from the merger of United Technologies and Raytheon. You can kind of see that as another case study. There's a ton of times where that actually has happened, but when these mergers happen and these spinoffs happen, oftentimes the market wants to digest it. Not always. Sometimes these spinoffs are not good ones. They're just assets the company does not want. So be careful with that. Don't take that and apply to everything. Okay, investing is nuanced. But when we take a look at AMC, the potential of acquisition, I'm just going to share some thoughts on that. We have to consider the overall value of the content. And right now, I think, and I'm pretty sure they do state, and let me actually take us over here. Let me go up, actually. Right here. So increasing extent, such as a business depend on original programming. Okay, so this is a risk that they obviously, the risk portion of any business 10K will be like doom and gloom. But taking a look at this is a significant risk that I do see, that the market probably also sees as well. It's The Walking Dead. The Walking Dead is such a big portion of the value of this business that should it end at some point, that's a little bit of a concern. So I know that they are on their final season, I believe, and then the other variants of The Walking Dead probably have to pick up the slack, or something else has to come out to their benefit, right? So maybe an acquisition from Netflix would be a welcome sight for both the management team and from the sake of the investor base. While I might not think, I don't know yet, I might not think that an acquisition by Netflix would be wise from their perspective. But we'll have to wait and see. Let's actually, when we get to the model, we'll check that out, which actually we're going to head right over. So let's go over here and let's type in AMCX. And I want to make sure it looks like it is zoomed in enough. Okay, it's porting in. Give it some time. It's being a little slow today. There we go. All right, so already I'm just looking at it. It looks extremely cheap. So I think the market is, first of all, concerned that there might be some sort of cliff coming on the horizon, kind of like how pharmaceutical might have a patent cliff, right? Something like this might have a content cliff, and it might be the case. Now, taking a look at the enterprise value, this is when you take into consideration the debt and you're netting out the cash. So you subtract out the cash and then you add the debt. The company is enterprise value is at 3.2 billion. So you can think of this as the total acquisition cost. Remember when I've discussed enterprise value to EBITDA being a proper multiple when you're thinking about buying the entire business, and it's something I would do at work when we're trying to evaluate the prospects of buying a private business. We'll actually look at the enterprise value to EBITDA and make sense and see if it makes sense to add it into the overall business, right? So, but if we're looking at buying a stock or part of a company, in this case, like in the public markets, we won't really care about enterprise value to EBITDA because we're not. But if we're looking at it from the perspective of Netflix, then that changes the story, and you can kind of see how that is. So taking a look at the enterprise value, we might actually figure out or see on a PE basis, right, by a GAAP net income, PE basis, it looks extremely cheap, right? So I can only imagine what it looks like on an enterprise value to EBITDA multiple. So the way we can kind of rough see that out, and I usually don't calculate that here, so we'll actually go to the data sort, and it should be that it's already there. So EBITDA is right there. So EBITDA is at about 1.4 billion. Oh my gosh. So it is at almost about a 2, okay? So Netflix would have to, and let me actually get into why you would use an enterprise value to EBITDA for a total acquisition. And that's actually where it comes from. It comes from like back in the 1980s when they started doing all these tuck-in acquisitions. But if used appropriately, I think it's fair. So enterprise value to EBITDA multiple is because like when we combine the businesses, right, we're going to remove obviously the cash. We're going to take on the debt when we buy this company, or that's going to be implicit in the buy price. And so then we want to look at what the income statement. Okay, so what in the income statement is going to have effect on the new entity when it's combined? Well, it's going to be above the taxes, right? Because the taxes will be paying together, so that'll be fine. We're not going to look at it in that perspective, and then we might have our own different, breaks on taxes, etc. And then also the way that the firm is currently depreciating or amortizing the assets might have variation. We don't really want to look at that either. We want to actually just look at what are the operations of that business generating, and then how would that look like if we tucked that into our business? Would that be a benefit? And then we will handle obviously the taxes and depreciation, all that stuff on our end as a combined entity. So in that instance, we would actually look at enterprise value to EBITDA. So looking at Netflix would probably think about the same internally, and looking at the enterprise value to EBITDA of 2, I start to see that yes, it does appear as though this would be a very cheap acquisition for something like a Netflix or Warner Brothers Discovery. Any of these guys, a very cheap acquisition would be AMC Networks. Now, the question now becomes, would it be allowed? Okay, would it be allowed? Which is obviously a question mark. Even though it is a small business, these companies sometimes are under tough scrutiny. I think Warner Brothers Discovery would be the least likely to buy it because they just went through an acquisition. They probably wouldn't want to be pushing their luck right now with this current chairman that we have. You know, she's pretty aggressive. And I think maybe Netflix would be the obvious choice. Amazon could do it. Apple, anyone could do it. Apple is actually less likely to do it too because they like to do things in-house. Not saying that Amazon doesn't. Amazon also likes to do it in-house. Heck, Google could do it. I don't know, for some like YouTube content. Who knows? But the point is, it does look cheap. It might be cheap for a reason. And this is actually what I will be a little bit concerned with. So taking a look down at the cash flows, we can see it is quite lumpy. Revenues is pretty stagnant around here. Around 2019, it's pretty stagnant and actually in decline from 2021. And it's estimated to decline. Let's take a look at the price target by analysts. They have it at a strong buy, price target of 57.65. Sentiment is actually fairly positive. I want to actually take a look at that and see what okay, it's like one mention on Twitter. That doesn't count. That really doesn't count. The sentiment is really positive, but that does not count. All right, let's take a look at kind of like a skim test on the articles being written. So we have an article written. What's the date? Oh, yeah. So, so none recently, actually. Yeah, AMC Networks declining, but not without rebound potential. This is Seeking Alpha, Global Newswire, Deadline. Okay, cool. I think it's fairly mixed, right? So there's rebound potential apparently. So let's actually take a look at the. I think we're actually, let's take a look at the ratios. That's what my brain fart was all about. So taking a look at the ratios, the current ratio is pretty fine. It's above 1. It's well above 1. The current cash ratio, I'm not going to really care too much about that. They aren't paying that much in interest, by the way. Their interest expense is about like 100-something million. So, and we can see that in the interest coverage ratio. They can more than afford that interest coverage and total debt, long-term debt. So long-term debt is kind of fluctuating. It actually is declining slightly right here. And long-term debt to capital, debt to equity, financial leverage. Okay, that's cool. Gross profit margin is remaining rather steady. I wouldn't really call that too much of an improvement. Operating margins is down. Okay, interesting. Net profit margin is also down. Okay, interesting. This is what probably the market is pricing in as super cheap, right? They probably fear that this is going to continue, and that's not good. Easy to say, but that's not good. ROA is coming down, ROE is coming down, ROIC is also coming down, and that's a concern. So also, just so everyone knows, this ROIC is using net income instead of cash flows. Earnings quality is rather poor right now, and it was rather poor in 2017. It correlates occasionally or sometimes with what's going on, but sometimes correlation is not causation, just so everyone remembers that. 2018, 2019, and 2020, we received high earnings quality scores. Free cash flow margins, you can see here it's fairly lumpy. Again, that's normal for a business like this. All right, but over time, it should actually reflect or match up with net income. So net income being probably more stable, accurate measure for this company. Taking a look up here, I mean, I don't know where to begin besides saying this is extraordinarily cheap right now because I'm basically assuming, I'm not even assuming the buybacks, which by the way, this has been cannibalizing itself as of late. Since 2016, they started to buy back the shares. Let me quickly explain why that strategy might be the case. So when a business sees that it's going to have a massive decline at some point in the future, I'll show another case study, or I'll talk about another case study, and that's Biogen. So Biogen is a business that had a decent amount of patent cliffs. They have this Alzheimer's drug that is not very effective, at least when I've spoken with subject matter experts, because it was, and I have permission to speak on this. It was a position within my employer's portfolio, and at a point of acceptance, that same day, we had sold it completely, and it was a very good move at the time. So we had it was a small position within the portfolio, the overall portfolio, and it was more on the speculation that had a very strong speculation based on political reasons that it would have been approved, and it did get approved. But then, the actual effectiveness of the drug was questionable. And so the company probably knew this as well. So we noticed that they were buying back an absolute ton of shares. And we're talking about Biogen again, still. And so a lot of companies do that in anticipation when they think that, things aren't going to be so rosy in the future. It's not always, but I'm saying this can be the case here. And so in anticipation for that decline in the future, they buy back a ton of shares, because now if you split among the same net income among less shares, you can kind of see or make up that earnings per share is going up. And it is going up in a real way. Now the question then becomes, how did they get the cash to buy back the shares? Did they do it through debt? Right? If they did that through debt, I'll actually showcase right here because I'm actually staring right at it. The Altman Z-score is kind of ambiguous here in terms of bankruptcy risk, and the model's own measure is also ambiguous. It's like, I don't know, it might go bankrupt. I have no idea. So the debt really is a problem relative to the size of this business. However, interest rates being so low as they are isn't a problem right now. Now, I don't know the exact debt covenants of this business. That'd be something interesting to look at, actually, if I was considering to make a major purchase in this business, because I've now identified that one of the key risks, and this was supposed to be staved off to the end of the video, but we'll say here, is the actual debt, right? The debt actually might restrict the business in some capacity. Maybe they have some debts they have to roll over, and it's going to be at higher interest rates, and that's not going to be a good thing. But let's take a look. For example, let's hypothetically say that they're going to do some buybacks, and the max buybacks that they're capable of doing the model says it's about 6%. That's a lot. So let's say they can do 3%. Let me activate the model. 3%. Okay, and let's say we're even more uncertain based on this business, and I actually will show you guys how discounted the market really has this stock at. We're going to get cheaper and cheaper and cheaper here. So 20%, 25%, even 30%. Crazy margins of safety here. So what is this telling me? Well, the market is either just completely overlooking this, or there is some decline in this company's future with the end of The Walking Dead, and the market's just pricing that in. And then it would be what is called a value trap, or it's extremely cheap. Now, from the perspective of Netflix, again, let's revisit the idea of Netflix acquiring this business. I think it is not outside the realm of possibility based on how cheap it is currently on enterprise value to EBITDA, and I doubt the decline is going to be that drastic in the next couple years. Of course, Netflix would probably pay more than the price it is today, obviously, but the question is how much more. So if it were to get, for example, an enterprise value to EBITDA of about 3, that would still be, because here's the added question. How would that affect the way in which AMCX produces income as a business inside as a subsidiary of Netflix? There might be some implications or changes as to how the company produces income, or Netflix might adopt a strategy where it's a slow transition into the overall business. Okay, and what that would mean is AMCX would continue its operations as normal, maybe until some of these things expire, and they would try to extract the value to Netflix as a return for that acquisition, and then at some point in the future make a full transition. Part of that transition would include over time all of the content being added to Netflix's library, without obviously Netflix necessarily either paying their subsidiary or not paying their subsidiary. And then just canceling out those transactions. But I would assume they would do the latter, just not pay and just own the series outright. So there's a couple of things in there, or that's all speculation, by the way. All of this is speculation in terms of the acquisition size, but looking at it as a standalone investment, you could discount this stock quite heavily and come up with that scenario. One thing I would be concerned about, and this is actually where we get to the more probable scenario. So let's go back to that 30, and we're still discounting it quite heavily. Let's say the risk is there and it's drastic, a 10% decline. So a 10% decline Could we still, you know, be less aggressive? You can see there, right, boom, right there. A 10% decline is still not a buy if you want that level of margin of safety. And 10% decline might be possible, just so everyone understands that. It could happen. If the rest of their shows aren't a hit, and the thing is, it's kind of like a cascading effect. As the shows begin to fail, and I'm saying it as if it's going to happen, but if it does happen, that would be a problem. Now, this is why the company's trying to transition over to the subscription-based model, because the beauty of the subscription-based model is that recurring revenue, and it allows you to have that steady stream of income to then produce more content, versus the advertising revenue actually relies on the amount of eyeballs you have. And like I stated in the Netflix video, you guys have to think about that nuance, that very specific nuance. So this is the same for all of these companies, Warner Brothers, Discovery, Disney. If you're subscribed to their service, they don't necessarily care too much about you watching it per se. It's not a net addition to their revenue. They care a lot in the sense that you're going to be more likely to cancel if you don't watch that one as much, of course. But if you're going to pay it, let's say you pay it at the end of the month, no matter what, then they won't be too upset if you don't watch a show or two, right? So AMCX is pursuing that model because of that reason, because the advertising model is heavily reliant on the quantity of eyeballs and the duration of those eyeballs. Very similar to YouTube right here. YouTube is predicated or benefits from you watching more and more YouTube videos for greater and greater duration, because you're not paying YouTube anything. YouTube Red, of course, then at that point, they don't care how much you watch of YouTube, only that you watch enough that you feel like you shouldn't cancel it. That's about it. But as far as that goes, you know, it's to their benefit on that end. All right, so to summarize the points here, AMCX looks extremely cheap. I can see the thesis behind what Everything Money has stated. I understand why they think it might be a good acquisition target. It's not outside the realm of possibility. I do, however, think that the market is telling you here they might have a decently sized decline, and they haven't proven their streaming service yet. However, if all that aside, and you're looking at this business and you think they are going to figure out the streaming, it's going to be great, and you're excluding an acquisition from a foreign party. They're going to do great in their streaming. Again, they're small enough that, you know, they don't need much to actually move the needle. Just so remember that one benefit I mentioned. Being small has two sides of a coin, a benefits and a drawback. I think the benefit is if they do execute well with the streaming, this could be a stock that returns a lot to shareholders. It is very possible. And if they continue to do buybacks so aggressively, just on that merit alone, you know, you could have a good story here. You know, you could have a cannibalizer on your hands. However, I would prefer them not to use debt to buy back shares. I would prefer that. And I have a hunch that they have been using debt to buy back shares. Or if anything, I mean, they might be justifying because they're like, oh, rates are so low and our stock is so cheap. Maybe that's their justification. And I know management would actually undoubtedly make that justification. In fact, they do so all the time. A lot of companies will say, well, our stock is cheap. We're going to get a greater return buying our stock. And, you know, the debt's yielding like, I don't know, 5%. Our stock is yielding on a cash flow yield of 15%. We buy our stock all day long. Okay, fair enough. Maybe, but still you're adding risk to the company when you do that, okay? So on that note, guys, thank you guys so much for watching. If you guys have any questions, you can comment down below. If you guys have any questions during the Discord community, you can ask me there. And on that note, I'll see you guys in the next one. Bye.